Bulls leading the risk rally that has run since October may be about to hit a brick wall as liquidity starts to drain out of the global financial markets once more. Quantitative tightening by the Federal Reserve has long been seen as a reason to be more risk averse, but over the last 3 months or so there have been decent flows supporting equity markets. However, that may be about to change. Citi's Matt King points out that the reason for the rally is down to some arcane liquidity-related central bank actions that may be behind us. He notes obscure technicals relating to central bank liquidity, such as declines in government deposits at the European Central Bank and reserves at the Bank of Japan and People's Bank of China, which has added a collective $1 trillion in additional liquidity since October. In the US, a fall in the use of the Fed's overnight reserve repurchase agreement facility, as well as a decline in money held in the Treasury's general account, have also helped improve flows of cash into the banking system, even as reserves fell. But all that could be over now, and the rest of the year is likely to see declining liquidity and, as a result, fewer technical factors supportive of equity markets to rally further. And according to Citi, this is more than just a load of market noise. The $1 trillion is worth about a 10% boost for stocks. As we noted in the Watchlist 2023, our preview to the year ahead in the markets, declining liquidity will present itself as one of the most important causes of market volatility in the months ahead, particularly as the Fed continues to raise nominal interest rates. The Fed's quantitative tightening is making low liquidity and high volatility in the $20 trillion US Treasury debt market even worse. The Fed has moved from being the largest marginal buyer, accounting for around 40% of the market, to become a net seller. And certainly liquidity problems have been brewing in the Treasury market for some time, but there is a risk that the more QT is done, the more acute these might become. The Federal Reserve raised alarm bells last year, warning in its financial stability report of the systemic risks posed by declining liquidity. Such is the extent of the potential for market volatility and dislocation, the Fed may be forced into halting QT in order to shore up financial markets and prevent instability in the crucial Treasury and overnight repo markets. That would result in a significant ongoing liquidity injection, but it remains to be seen whether the Fed would be willing to risk inflation getting out of control again just to protect financial markets. Indeed, the Fed will be reluctant to stop QT since a large chunk of the $5 trillion pandemic QE is responsible for today's inflation. You would accept that shrinking the balance sheet by QT is an important tool alongside rate hikes to curb inflation. Stan Druckenmiller, the famed investor, warned last year that all those factors that cause a bull market are not only stopping, but are reversing. That process has been on pause since October, but the reversal looks set to begin again in earnest, unless the Fed decides to step in.